Today on Money Life, you're going to hear Michael Green, chief strategist at Simplify Asset Management, talk about a bubble on a bubble, how certain categories of investment are like juggling razor blades, and make an economic prediction that sounds like this.
Again, whether this plays out, whether we see a giant set of stimulus again, that's speculation at this point. My hunch is that there will be a recession and a declared recession this time around that ultimately manifests itself in lower market prices, and then we'll have to see what the response is to that.
But we've also got Jacob Ayers-Thompson, chief executive at 3AI, talking about how AI is going to reshape and alter the index landscape, as in how indexes are built and put together. Plus, Michael Scordo, wealth management advisor at Park Avenue Capital, is here discussing the latest research from Northwestern Mutual's 2025 Planning and Progress Study, which shows that Gen X, the middle child of generations, is now the one that has the most worries about its financial future.
Enough talk. It's showtime.
It sure is, and welcome to the show. This is Money Life for October the 15th. I'm your host, Chuck Jaffe. Thank you so much for joining me. We have a great show planned and executed for you today. It is a show that I am going to keep the intro short on, even though I have been dying all week to find the time to talk about something that if I were still writing the stupid investment of the week, there's absolutely zero question in my mind this would have got it, because there's a new ETF that came out last week, and you guys don't hear much in the way of ETF launches. And I love Todd Rosenbluth, but he doesn't normally pick on things that he thinks are bad, right? Tom Lydon before him didn't do that either with ETF of the week. But there's a new ETF out last week, or it's kind of a new ETF. It's the Roundhill Meme Stock ETF. The ticker is MEME, M-E-M-E. I say it's kind of new because they tried this basically during the pandemic and it ran for a couple of years and they closed it. And now they're coming back with the same basic idea, but a different approach.
What a dumb thing to do.
Exactly. That's your problem here, because the idea was never all that sound. Okay, you're going to try to do this by actively managing meme stocks, which are highly active and highly volatile. You know, if you want to be in on the meme stocks, you can be there. But to say, oh, let's try to make them somehow more palatable. Well, the truth is, while this is not the juggling razor blades exactly that Michael Green is talking about, it is kind of that juggling razor blades thing, because he was talking about like some single stock ETFs and some things that go heavy into leverage. This is a variation on that. So when you hear Mike Green, Simplify's creating new funds, he's talking about what he's not interested in doing, because it's the stuff where you can't help yourself. You're just trying to cut yourself, right? Yeah. It'll tie all together, but if you're looking for something and you want to know that I already think it's dumb, that would be it. There are not that many times where I go, yeah, I really wish I was doing stupid investment of the week, but you kind of love it when it's an easy one. And yes, a fund that was killed off and then brought back from the dead. Well, I don't know of any other ETFs that's actually happened with. So I can't say, ooh, it's never worked before. Nobody's ever tried it before, because it's a terrible idea.
This is one of my worst ideas ever.
I'm Chuck Jaffe, financial columnist, your host here on Money Life. We love to hear from you, so Chuck at moneylifeshow.com. Enter our contest this week. I just want to point out, I think we made it clear, but we got a couple of entries yesterday that didn't include the address of the person sending it to me. The rules are send your name, your address, and your entry. Put that in there, and we do follow the rules. We aren't saying you can't enter again and send back with the address. But if you don't send us the address, you're not winning the contest, because that's actually what the rules say. Yep, send that stuff in. But right now, we have to jump to it, because we're going to let Mike Green run. We're going to let Jacob Ayers-Thompson run. Great stuff coming. So really interesting, different twist on the AI discussion. That starts us off. Then Mike Scordo talking about Northwestern Mutual's Planning and Progress Study and Gen X, and then Michael Green. Thanks for being here. The talk starts right after this message.
Exchange is more than a finance conference. It's a community. Join us to gain insights and connections that last. Visit exchangeetf.com.
Welcome to the other interview on today's show. And today we're going in Well, we know it's an interesting direction because all anybody seems to want to talk about these days is artificial intelligence, but we're bringing it into how it is impacting the financial world, not from the standpoint of like, oh, artificial intelligence, invest in artificial intelligence companies, but no, how AI is changing things like indexes. It's been a discussion that we've had here on the show where we're talking about index construction and what's been going on. Well, there's a lot of discussion about how AI is transforming finance. And we wanted to look at some real world stuff that is happening. And so my guest right now is Jacob Ayers Thompson. He is Chief Executive Officer at 3AI, which is a fintech company based in London. And they are working with a number of companies to help develop indices. Of course, if you listen to the show, you know that, well, now there's an index for everything. But rebuilding indexes, looking at various changes and using AI to power them, that is fairly new. If you want to learn more about what they're doing at 3AI, it is 3ai.co and no M on there. It's just 3ai.co. Jacob Ayers Thompson, welcome to Money Life.
Hi, Chuck. Thanks for having me on.
While AI is learning from everything that has come before and everything that is out there, I've said for a long time, if indexes had not been created up to now, and you got a bunch of people together and you said, we should do this thing, and everybody said, what a great idea. Well, what we would not be creating is anything that looks like all of the most popular indexes. We'd be creating something different. So why do the legacy indexes not necessarily give us what we want? And how is AI giving us something better?
We could write a book about that and have done a good 15, 20 years of dedicated research and essentially into that. I mean, in short, if we look at indices, they're kind of conventionally academic properties. They're built for doing things like monitoring economic, GDP, population counts, fatality, and data like that. The market cap weighted approach to indices is essentially a relatively thoughtless approach, right? So buy things in proportion to their size. So when Tesla entered, and even the CEO Musk said this is hugely overvalued, um, when it enters an index, the index has to buy the amount in proportion to its size relative to other stocks. It essentially is a relatively thoughtless approach to investing. At 3AI, we'll talk about indices. Really, the core of what we do, we call our alpha intelligence. So we go much, much deeper into data, much, much deeper into the generation of features and factors. And effectively, we have a kind of machine learning process or factory production line just to generate the data that our machine learning sees and is trained on. We have what we call a centralized intelligence network. So if you think about, which is essentially an interconnected group of AI minds that know different information and share that with each other. So it's a bit like I worked on a trading floor at Barclays, for example, and Goldman Sachs, and you would have different experts. The person who's an expert in equities, maybe covering Rio Tinto, is not an expert in forecasting gold like the gold trader, and is not an expert in forecasting the currency of the future currency moves that will impact Rio Tinto's revenues and costs. If you could put all of those minds into one mind, which you can do with artificial intelligence, it's one of the advantages it has over biological intelligence, then you are better able to forecast all things, because to forecast one thing in truth, you need to forecast everything, because in the stock market, everything is interconnected to everything else in some way or other, which is Leonardo da Vinci's fourth principle, by the way, for the development of genius. AI is perfectly suited for that fourth principle. All the minds connect. The other thing is as well is essentially what we're really focusing on at 3AI is developing an artificial intelligence layer that sits on top of data. So if you think about Mike Bloomberg creating Bloomberg, and you think of Reuters with Refinitiv, what's now Workstation, they're essentially databases with a GUI, right? So your traders, salespeople, research analysts are able to sit there, quickly look at stocks, quickly look at markets and economies, and see a lot of data. The data in there is far too much, obviously, for a person to really look at, and even more so too much for a person to analyze historically how all that data is kind of interrelated, and therefore what you can glean from learning from the past to analyze the present to predict the future. Machine learning is mankind's most advanced scientific method for the learning from data. It's also contains the most advanced methods for how to deal with all of the problems of finance, such as overfitting, underfitting, variable selection, and all of the other problems that are the kind of the trenches that quants wade through in their day job. So essentially, really at 3AI, what our alpha intelligence really centers on is forecasting of stocks, how to optimally forecast stocks, and we're continually adding new layers of intelligence into that. So what we're using machine learning to do is to build essentially an alpha refinery to go into data, mine out alpha through future forecast, and then supply that to industry, which we're supplying to hedge funds, investment companies in the form of data.
And there's two different things here. Part of what you are doing, as I understand it, is you are helping to build indices. And an index, really, it's not about being forecastable. Forecasting is the way investors, but also your AI learning models, react to the circumstances of the index. Because again, if you can make it that an index is forecastable, well, that defeats the purpose of the index. The index is supposed to be measuring. It's not supposed to be restrictive, but it's also not supposed to be predictive, right?
Our alpha intelligence isn't trying to forecast the performance of an index per se. An index itself, if we just think of like a long only one, is simply a linear algebra equation of a sum of positive weights to whichever stocks are in the index, right? Though we can forecast that because we're forecasting all of its components if it's a pure equities index, i.e., all of the underlying stocks. What we're focused on through our technology is the forecasting of stocks and the explanation of that forecast, which we now have back to every single factor. So it's today over around 400 factors per stock, and explaining it also through text. So we're producing about 50 pages of report per stock covering 20,000 stocks. So our alpha intelligence is essentially writing today about 1 million pages of equity research per week across the global market, covering $100 trillion of stock, circa that amount. So if you're creating an index, what's better to look at? Small segments of current data and limited current data, or to analyze and learn from all of the past relationships to data and then use that today based upon that stock's particular data sets, items, factors, measurables, to then forecast it today and then bring that in. So it's a bit like, you can sort stocks by yield, by growth, by quality, momentum, credit risk, a variety of things. Our machine learning essentially performs a research on every single stock, thinks differently about every single stock based on what it sees in the data, and has been trained on about 1 million years of stock data. So effectively, we're using machine learning for superhuman level quantitative research and the compression of that into knowledge, or a brain, if you like, which is then used to analyze every single stock today to forecast for tomorrow. So it's a kind of naive approach. For example, let's think about if you wanted a low risk index, you might have like a low vol index, for example, which would pick, let's say, the 20% lowest volatility stocks in the S&P 500. It's a naive approach with a false assumption to simply sort them by volatility of stocks over the last 5 years and pick the bottom 20, because there's a lot of other data that will give you insight into the future volatility of those stocks. So surely it's better to research what drives future volatility point in time and learn the relationships to present data all through time, and then use that intelligence or that learning or that research to then identify the stocks with the lowest volatility forecast today, not the lowest volatility yesterday, and assume that will be the lowest volatility tomorrow. So the traditional approach, systematic approach, somewhat to the construction of portfolios is really looking at current data points and assuming they'll be persistent in a way, whereas we're going much, much deeper. I mean, if you think about the construction of the kind of products that you see in the ETF and index space, if they see a stock with high revenue growth, do they go in and look at accruals to see if that's really coming through in cash flow? Do they look at the credit risk? If they look at growth, do they look at the value? Do they look back at the last 10 years of financial statements to see what's really going on with the company? There's no products I see in the retail space today that would make Warren Buffett happy, or in the UK, Terry Smith, he's kind of was perceived as our equivalent, would make them happy to invest in a stock. Because when you look at 3 or 4 factors, you don't know the company behind the stock. You're looking at a very limited, small amount of data points. The truth is, in investing, like in all competitive fields, the people that know the most do the best. But to know the most, you've got to ask the most questions. That's looking at data. That's going deeper into data, deeper into the stock, deeper in, especially into the company behind the stock as well.
Does that effectively put Warren Buffett and Terry Smith and guys like them out of business? Why am I ever going to rely on a human when I can instead rely on AI and bring in all that data? Is the ultimate end of we build better portfolios, we build better indexes, we get more predictive results, that congratulations, Warren, you retired at the right time?
I don't think so, actually. I think this century's Warren Buffett will be empowered by AI. So in the same way that you won't find a decent like trader in the markets today that doesn't have a Bloomberg or a Refinitiv terminal and access to other, and typically these days as well, some quants and programmers with them as well. In the same way that you won't find them without that kind of armory, I think the investor of tomorrow will be the same, that you're not going to find them without a kind of AI co-pilot that does what our technology does, which is to analyze from all the data, learn from all the data, and then to focus human intelligence into areas not well suited to machine learning, and there are plenty. So I'll introduce a kind of term that we have in house, which is that we divide data into two types. One we call homogeneous stock data. So that's data that has the same meaning for every company, things like profit, momentum, etc. Obviously the financial statements, the analyst rating, earnings expectations, EPS beats, that kind of data. But if you look at, say, like monthly average users, that's only applicable to, let's say, app companies, and listed there's only a small number. Because stocks are so noisy, you need a large number of stocks to learn the truth. It's the case of anything. If you had a coin with a 50.1% bias, you'd have to toss that coin a lot of times to identify the bias. Whereas if a coin had a 90% bias, you could identify that in 5, 10 tosses. Well, certainly probably like 10, 15, 20 tosses, you'd identify there's a statistical evidence of a bias. So the truth about stocks is they're incredibly noisy, and so you need a lot of stocks for it to be well suited to machine learning. You need a lot of data. So we focus on what we call homogeneous stock data. And what we think is going to happen is that companies like ours will educate the fund managers to focus on what we call the non-homogeneous stock data that currently requires that kind of general intelligence that a human has to look at it, to evaluate it. And also will be educated by companies like ours to the data sets that are not well suited to machine learning, where the human should focus. The key really is a bit like when planes and cars and bikes came and never chopped our legs off, because we still walk upstairs and we still step out of cars and we still like to go for a jog. So, and it's nice to stroll on the beach. But, and actually to this point, we're actively working with a fund manager today on the implementation of our system as a co-pilot for their active equity investors. So this is coming soon. You'll see this in the market in the not too distant future. We can't mention the name. If you think also about what has been essentially eating into the alpha capability of let's say the fund manager, because we're focused very much on the investing, not the trading space, the growth of the quantitative researcher and they're digging into empirical data and learning from it, which has succeeded and generated alpha, is eating into their capability to get alpha out of conventional data sets. We also, through the machine learning, essentially it's like having an army of a million quants that go and find every pattern possible and stitch it all together and give you all of that at the click of a button. So you'll then have a shield against that kind of quantitative alpha process that would have traditionally eaten into your alpha capability as a human investor. So I think actually that the better investor of tomorrow will be a human with AI than AI. So a human that learns well how to spot the gaps, look at other data sets and intuitively work with it. That will be the best investor. That would be better than any AI system. That's my view today of this. Now, if somehow we developed new methods of learning that didn't require lots of data, that would be quite different. But that's not there yet.
It's a fascinating discussion. I have more questions. I just don't have more time. But Jacob, I really appreciate the insight, and I'm glad to know that we're not going to see all investors and all fund managers replaced by the robots too soon. Thank you for joining me on Money Life to talk about it.
Thanks, Chuck.
That's Jacob Ayers Thompson. He is Chief Executive Officer at 3AI, which is online at 3ai.co if you want to learn more about what they are doing. And if you want to live the money life some more, well, settle back, don't touch that dial, don't touch a button or anything else, because there's more to today's show right after this message. Stick around.
Asset managers, you know how hard it is to stand out in this crowded space. Vetify is a unique partner that can help you across the entire product lifecycle. With a best-in-class index factory and an award-winning digital marketing team, Vetify can help you build the products of your dreams, optimize your distribution efforts, and grow your assets under management. Learn more at vetify.com.
Now Money Life looks at what the survey said. This is the survey said on Money Life. It's where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today, we are looking realistically mostly at Gen X because we're digging into the latest results out from the 2025 Planning in Progress study done by Northwestern Mutual. Over the course of the year, as they have been releasing different parts of the data, we have been talking with them about some of the conclusions. This one is looking at Gen X because Gen X, well, the oldest Gen Xers turned 60 this year, and more than half of them don't believe they're going to be financially ready to retire when the time comes, and the time is coming quickly. If you want to learn more about it, well, Northwestern Mutual is online at northwesternmutual.com, but we have a direct link that gets you to the Planning in Progress study and all the results from it on our show notes or where you find my guest. Michael Scordo is a wealth management advisor with Park Avenue Capital, which is a Northwestern Mutual private client group company. If you find him on our show notes, you will find the link that gets you directly to this study. Mike Scordo, welcome to Money Life.
Hey, Chuck. Thanks for inviting me on the podcast today.
We hear tons about the boomers. We hear a lot about the millennials. Gen X is basically the group that's up next. It's not that boomers are done. As a late stage boomer, I'm not there yet. But Gen X was also squeezed in that they're the first generation that kind of was raised thinking I won't have pensions. And yet they're also this generation that's going, okay, I'm not there. So how much of this is just anxiety? How much of this seems to be reality?
I think it's a combination of things, really. To your point, Gen X is kind of in this sandwich generation, right? They're living with aging parents who, by the way, are also living longer with ever increasing costs of care. They've got potentially these adult children that are now living with them due to higher costs of housing and childcare and education costs and all the debt that's associated with that. So I think it's kind of this perfect storm, right? Where there's more and more of the burden to save and prepare for retirement is falling on their shoulders because, as you mentioned, far fewer of them have access to pensions, which helped a lot of the boomers cover their retirement expenses. And Social Security alone is really not going to do it for them.
We should remind folks in terms of generations when they hear labels. Gen X is people born 1965 to 1980. Baby boomers, 1946 to 64. The silent generation was 1928, basically right before the market crash till the end of World War II. Then it's millennials, 81 to 96. Generation Z was then through 2012. And Generation Alpha, we're not talking about them. Those are today's kids. But as we look at this, there are numbers, and I don't know if Northwestern Mutual has calculated its own. I know that several others have that kind of say, hey, at various points in your life, you should have X times your income being saved. And you would like to be getting to 55 to 65 and go, okay, as a general rule, it's 8 to 10. And again, I don't know if Northwestern Mutual has its own look at this, but between those two groups, 8 times, 9 times, and 10 times of Gen Xers in terms of having that much salary, it's 10%. So 90% basically are in trouble here to some extent, right?
There's no magic number. There's no, here's the exact amount or the exact multiple of your income that you need to have saved for retirement. To your point, Gen X is in this generation now where they feel like they need to have more than previous generations in the past have thought that they need to have. But we don't like to go down the path of here's the exact number that you need to have saved, right? Everyone's situation is wildly different. There's many different inputs and outputs that need to be calculated within those planning needs, right? And I think, that's part of what these folks need to really focus on. As advisors, we're tasked with helping clients identify their objectives, right? Figuring out what are the things that you want to make sure that you secure, and figuring out, okay, if I'm going to retire at age 55 or 60, it's not just, hey, I need to have this amount saved. It's, well, how do we get to that number, right? It's, what do you need to live on? What are the expenses? What are the inflows and outflows? And I think identifying those elements are the key components to figuring out, am I going to be okay for retirement?
When it comes to Gen X worrying about it, how much are they just kind of following the standard playbook for anybody who thinks they're not going to have the right numbers and just going, well, I'll just work longer? Have they come up with any better solution than that? Because that's a fine solution as long as your health is good and your employer wants to keep you and the rest, but it doesn't really work out for everybody.
That's exactly right. I mean, I think, and the article does a good job of highlighting this, nearly half of Gen X believes that they're going to continue to work in retirement for one reason or another, most out of necessity, which is up significantly from previous generations, right? The boomers, they were targeting around that 30%, felt that they needed to work in retirement. And I think that stresses the importance of starting early, understanding what that all means, right? Do you have to work an additional 2 years? Do you have to work additional 10 years? Can you work full time? Can you work reduced hours? Helping identify, well, what if I can save $5,000 a month leading up into retirement? How does that all factor in? So I think those are all key components that, a financial plan ultimately can help these folks get some clarity on.
Gen X has a reputation at this point of still not wanting to turn for help. We know that the Planning in Progress study always shows the value of planning. What percentage of folks feel like they're behind because they haven't done a good job planning?
More than half of Gen X, 56%, think that they will likely outlive their savings. Less and less folks are planning on helping themselves by really working with an advisor, right? 33% of Gen Xers currently work with an advisor compared to 43% of boomers. Taking the guesswork out of this ultimately removes a lot of that stress and anxiety that we talked about earlier, where people tend to focus on the short term, right? They see the cost of an advisor as this outflow, and they think, well, I could do it myself. And that's a slippery slope. And frankly, I don't disagree, right? I think most of the folks that we work with are smart, successful folks, intellectually capable of doing a lot of the stuff that an advisor does, but it ultimately becomes this bandwidth issue, right? It's hard to be good at what an advisor does and good at what they do at the same time. And secondly, people focus on the fact that they're paying for an investment advice. And that's just a small part of this overall picture, right? I think the bigger element of working with somebody and getting advice on what they're doing from day to day to help them achieve their goals is more the behavioral guidance element, helping people avoid making these rash decisions when the market dips, which is bound to happen several times during their retirement, and having someone there to help stick to the financial plan, not react to the ups and downs, is well worth it, and something I think is critically important for these folks.
It certainly is, and of course, one of the reasons we tell people that we look at studies like this is if you can learn from the experiences of others, you can make things better for yourself. And that's definitely what we hope folks will do. If you're in the side that says, I think I don't have enough money or I'm not going to get there, you need to change things now. Mike, really interesting. Thanks so much for joining me to talk about it.
You're very welcome. Thanks a lot for having me on. Looking forward to doing it again.
That's Michael Scordo, Wealth Management Advisor at Park Avenue Capital. It's a Northwestern Mutual private client group company. You can get more information on Northwestern Mutual at nm.com. You can find the survey and all the things we've been discussing at the direct link. It's in our show notes or where you find Michael on our guest page. We've got more to go. So we were talking about planning. How about you plan to stick around? There's more Money Life in just a moment.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Welcome to the big interview on the October 15th edition of Money Life. Joining me now, Michael Green, Chief Strategist, Simplify Asset Management. And if you look up the firm, simplify.us, I spend a lot of time on financial services firms' websites. There is one thing I particularly like about Simplify because their ETFs, a lot of stuff with options and other strategies, that it's all about kind of getting a pure play asset allocation thing. I'm not going to get into what they do necessarily, but what I'm going to point out is they actually do what I consider to be valuable videos on the fund. Well, a lot of places will do, here's a quick tip sheet, etc. But you can do what they call their fund deep dive on a lot of their funds. You'll find it at simplify.us, and it's a really good explainer. So if you find that their Simplify ETFs are a little complicated in some of the stuff they do, you can get a great explainer. Now, Michael Green, well, beyond being their chief strategist, he's a portfolio manager. The Simplify High Yield ETF, ticker symbol CDX, is one of his if you're looking for more information there. And if you want to find out more about what he's thinking, go to yesigiveafig.com. That's his Substack, his thoughts on financial markets and what's happening with the economy. Mike Green, it's great to have you back on Money Life.
It's great to be back, Chuck. Thank you for having me.
So let's start with your take on the market and the economy, because we've got a number of people who have been coming on this show of late going, yeah, I think it's a bubble. I think we're going to have trouble, but we're not going to have it for a while. So are we inflating a bubble? Is this something where trouble is somewhere on the horizon, but not for a while? Or is that an oversimplification of what we've got?
Well, so the quick answer is I definitely fall into the camp that says it's a bubble. And unfortunately, I would argue that there is a bubble on top of a bubble in the AI space. What we are seeing in AI, which has captured people's attention and is certainly capturing their investment dollars at this point, is an unbelievable opportunity for productivity enhancement, in particular for white collar type jobs that would have historically been thought of as relatively immune to productivity advances or technological advances or enhanced by them. At least in the short term, we're seeing emergence of technology that in many ways can replace or certainly dramatically improve the capacity of particularly people who have what I call domain specific knowledge. I liken the use of AI, which I use every single day. I actually had a really interesting experience. I was in Asia for a couple of weeks, including a stay in Hong Kong, where ChatGPT is blocked. It's on the other side of the Chinese firewall. And one of my real tests for technology is like, do I miss it when it's gone? Right? Can I put down my cell phone? Yes, but I miss it. Right? Can I walk away from components of social media? Yes, but I miss it. If I'm asked to, walk away from my microwave for a week, I don't really care all that much, right? It's not that big of an impact in terms of my life. The inability to access ChatGPT honestly felt like I'd lost one of my thumbs or something. It was a really interesting experience. And so I just want to separate that this is actually a really important technological innovation. The ability to use large language models to improve your communication, to improve your thought process, to improve your analysis and do everything from writing legal documents on down, is progressing at an astonishingly rapid pace. The investment that is accompanying that and the nature of the investment, many of the circular components that have been highlighted in terms of one company buying products from another company and in making an investment to help facilitate that, or components of vendor financing, are clearly indications that this is a capital spending bubble that ultimately can't be supported at the levels that are being indicated. And honestly, I don't think that they will need to be, very much like the laying of fiber optic for the internet or components of the dot-com cycle. We're forgetting that one of the tools of technology is to improve itself. And so we're beginning to see dramatic advances in terms of cost reduction and processing capabilities in LLMs, where reduced scale models and specialized models actually work better in many ways than do the very, very large language models that are driving the data center spend, et cetera. So my hunch is that we will ultimately see once this is washed through, we'll see something very different. The bubble itself, I actually argue, is caused by the growth of index, broad market capitalization index investing, which is going to be the lion's share of most of your listeners' portfolio, because we have very successfully shared the idea that index investing is the safe and appropriate way to invest. Unfortunately, what we're now discovering is almost anything that is done at scale, and particularly the scale that we've now achieved in passive investing, is creating a feedback loop. It's very perverse if you actually think about the dynamics of what happens with a market cap weighted index. You allocate more of the next dollar to something that has gone up in price. In economics terms, that means you have what's called an upward sloping demand curve. You buy more of something as it goes up in price. That is contrary to any mechanism of valuation or mean reversion that we've historically seen in markets. And as more and more people have been pushed into passive investing by largely government diktat through the Pension Protection Act in 2006, it's inflating the all asset bubble that people see broadly. And many have tried to address it through fundamental arguments or indicated that it's tied to some form of social mania. There are certainly components of that, but the enabling feature is actually this growth of passive investing that you and I have talked a little bit about before.
A bubble on top of a bubble. Does that end with a bigger blowout when it happens? Or does it somehow implode on itself and soften the blow?
So that is actually one of the more interesting questions. The indications, the indications are that we have actually seen examples of those bubbles within bubbles correcting themselves. I would actually argue that this overall bubble has been in place really since the early 1980s. Once we began to allocate funds into index investing, it accelerated dramatically in the 1990s. You may remember Greenspan's reference to irrational exuberance, what became the title of Robert Shiller's book. My work suggests that that was actually the initial implementation and implications of passive investing at smaller scale. So we have actually seen those bubbles on top of bubbles correct themselves. But if you remember the commentary, we actually have seen components of this, right? So in 2000, valuations did not retreat to levels that would have been historically cheap. In 2008, 2009, we also fell nowhere near the levels that people would have anticipated had this really been a clearing event. That was that underlying bubble, the individual bubbles of the dot-com component, the individual bubble of the mortgage-backed financing component in 2007 and 2008 corrected themselves. 2008 had some interesting characteristics to it as well in terms of the failure of Lehman Brothers, but we have not really corrected that underlying bubble. Whether this is where we hit that limit or not, I'll be honest with you, it's really going to depend on investor behaviors.
Have you got a sense of timing of what has to happen before we hit that limit? Like, if you're talking about investor behavior, that's different from consumer behavior. Whether the consumer becomes exhausted, that is different from we see inflation stay sticky and what have you. I mean, obviously, the market disconnected from the economy in terms of you don't have to have a hard landing to have a bad market, but like, which will we see first, or when will we see something first?
Well, my hunch is, unfortunately, that part of what we're seeing is elements of that right now. So with the federal government shut down, we've seen a slight loss in terms of inflows into vehicles as federal workers are increasingly not getting paid. Ultimately, their contributions to the equivalent of 401ks are beginning to decline. It's almost like we've gotten a shock to employment. But with that said, we're seeing two factors that are really heavily influencing this. One is that there is the economic question of, do we see an increase in unemployment? That would be the downside to something like the AI boom. If that ultimately manifests itself in not necessarily a dramatic increase in demand, but instead a dramatic increase in productivity, that could lower demand for labor. Those workers are ultimately the participants in this bigger bubble that I'm referring to because of 401k withholding, et cetera. The other factor, and I'm sure you had any number of people who have talked about the demographic features, the simple reality is that more and more funds are flowing into things like target date funds that simply mechanically reallocate between fixed income and equities as you age. And as baby boomers are hitting that retirement period, we're increasingly seeing their portfolio allocations shift to more conservative allocations. There's many who are resisting that for the simple reason that the S&P has been a phenomenal investment for this past several years. And even 5% treasury rates were not enough to attract them away. The certainty of those 5% treasury rates were not enough to attract them away. If anything, we're seeing the opposite behavior where more and more people are beginning to explore, well, maybe I should reduce my 60-40 to a 60-20-20, replacing 20% allocation to bonds to a 20% allocation to gold and a debasement framework, or to alternative investments. Sometimes simplified products fall into that category. So I'm happy to see that in some ways. But I also would emphasize that people are largely ignoring the opportunities that exist in bonds. So those demographics will eventually play through and have an impact. We're just at the very leading edge of where that should begin to end up playing out.
You talk about people ignoring the advantages of being in bonds. Aren't they more likely to be ignoring those advantages going forward as we're at the beginning of a rate cut cycle? And at least intuitively, rate cut cycle means bad for fixed income, even if that's not necessarily the case. That's what the common investor thinks.
Well, that actually is one of the things that creates some interesting opportunities that, again, I would argue most people have largely missed. One of the features within institutional portfolios, particularly insurance companies and others, is they try to asset liability match. And one of those characteristics is what's called duration exposure, right? This is ultimately long-term interest rate exposure. As the Fed starts cutting rates, one of the important tools that exist in those investor toolkits are things like mortgages that picked up extraordinary duration with the increase in interest rates. Just to help your audience fully understand this, if you remember back to the prior to 2021 time period, it was a regular feature that you would refinance your mortgage at a lower rate. That meant that those mortgages had relatively short duration. They were actually shorter lived instruments than the 30 years that you had contractually committed to. When interest rates rose dramatically, that expanded the duration component of those in portfolios and increased the weights of duration exposure in portfolios tied to mortgages or that had significant representation in mortgages. As rates start to fall, there's about 25 to 30% of mortgages now that are sitting out there that become eligible to refinance. That means that duration in those institutional portfolios is shortening up. And that's really going to drive demand at the long end that has been ignored for an extended period of time. The challenge for your investors and your listeners ultimately is to decide at what point do I stop investing in my money market fund, which sits at the very front of that interest rate exposure, and begin shifting into stuff in which I have less uncertainty about my reinvestment risk. Where could I buy those longer dated bonds into the future? That's my expectation. That's what I think is ultimately playing out here as we begin to address an interest rate cutting cycle. The other thing, and I would argue that your listeners can actually feel this empirically, the dramatic increase in interest rates meant that many of your listeners who held assets like money market funds or funds in savings accounts because they weren't particularly concerned about inflation until the 21-22 time period, they're now actually suddenly forced to confront the fact that their incomes could begin to fall as the cash return on those money market funds fall. And so this actually is a paradox that the Fed is a little bit trapped in. By increasing interest rates, they think that they're slowing economic activity. But if the majority of debt is actually termed out and the majority of assets that are held are in the front end of the curve, that money market type exposure, hiking interest rates is actually stimulus to a sizable fraction of the economy. It's had the predicted effects that you would expect on areas that are heavily subject to financing, like housing, which has been very, very weak. Autos have been very, very weak. These are entities, these are capital equipment and durable goods that are financed and therefore subject to the traditional component. But on the flip side of it, they're suddenly looking at their money market fund and saying, wow, I'm getting 4+% on my money all of a sudden. I didn't have that before, right? And so as the Fed starts cutting, it's really unclear whether this will ultimately prove stimulative to that housing and auto sector or whether it will prove contractionary to the discretionary consumer spend, things like luxury travel, etc. A lot of people talk about the wealth effect. right? This idea that rising stock markets have led to increased consumption activity. I would highlight that the wealth effect generally is accepted at about 2 to 3% of the increase is spent in any given period. Again, I think many of your investors, particularly if they're registered investment advisors, will recognize this behavior. The marginal propensity to spend out of interest income is about 70%. In other words, the increase in interest income has played a far bigger role in consumer spending behavior than has the increase in the stock market, particularly for older generations that have lived through things like 2000 or 2008 and recognize that those equity assets could ultimately get cut significantly, even if they don't believe it right now.
Putting all of this together, I want to bring you back towards the market and areas that you particularly like or dislike. Given the conditions you see, a bubble on top of a bubble, an industry that is clearly leading, but also creating some potential problems. What are the areas of this market that you like and dislike particularly?
Well, as I alluded to, I ultimately think the fixed income is in the process of starting to rally significantly. Simultaneously, that shortage in duration also means that the dollar is highly likely to appreciate in this framework. I understand how frustrating that feels to people. And so that means areas that have done extraordinarily well, like equities or like gold, I'm just not a buyer of the debasement trade. I think ultimately it happens as a response to equity corrections, but I'm really seeing no evidence, whether it's the growth of M2, which is not really a great indicator, but certainly one that many people reference, that would suggest that there's any real credence to this debasement trade. Instead, what we're seeing is speculative behavior in gold and in equities that I think I've already hit on the components of it. It's basically people that have bought into a narrative to explain the current price behavior. So I am largely negatively disposed to many of the hot areas of the market. Areas that I think are really interesting are areas that generate endogenous cash flow. If you're looking at the quantity of dollars being supplied beginning to fall because either the government is levying additional taxes in the form of tariffs, the Trump administration is actually engaged, as painful as it is for many people to understand this or admit it, in a component of fiscal consolidation. That means there's less dollars available. Cutting interest rates would take that even further. And so assets that generate their own endogenous cash flows, in other words, generate it internally and return that to investors, are areas that I think are super interesting. That would include bonds. It would also include areas like high yield, which has a very high level of endogenous cash flow. Your typical high yield fund is generating about 20% of its assets as cash in any given year, a combination of maturing securities and the cash flow associated with coupons. Other areas that are starting to capture my attention are things like business development companies, which is a proxy for the real market price for private credit. BDCs have been absolutely hammered as many people seek out hedging tools for protecting against the large institutional balances that now exist in areas like private credit. That has created opportunity. We actually just launched a new product to simplify to take advantage of this that invests in BDCs, business development companies that are trading well below their book value, implying their bonds are marked well below par, while simultaneously pursuing the same type of hedging strategies that we've used successfully in the high yield product CDX that you'd mentioned before.
When it comes to what you are anticipating out of this market, I mean, at Simplify, you guys are in the business of putting together products that serve both a market need, but also fill a hole in your lineup. So I'm curious at this point whether there are significant more needs to fill because your fund lineup has grown dramatically, or if it's more now, okay, we've created basically the basket of products. Now let's see what works in various market conditions.
Well, there's a combination of the two, right? So, one, Simplify was a startup that grew out of the pandemic and a regulatory reform in September of 2020. You highlighted the use of derivatives in many of our products. That is because of a rule change that was introduced in September of 2020 called the derivative rule that increased the quantity and types of strategies that you could offer within ETFs. And so we took many of the hedge fund strategies that we'd successfully used for years and introduced them in ETF form. The market generally has received that very well. We've grown to about $11 billion in assets. And many of those tools are in place. We have products like CDX, the hedged high yield exposure, PCR, which is our hedged private credit exposure. We have CTA, which is a trend following strategy that runs with a negative correlation to equities, provides a tremendous diversification benefit within portfolios, and behaves in many ways like a hedge while offering a positive embedded return associated with a trend following return profile. We intentionally exclude equities from that portfolio so that it provides a diversifying benefit to investors. Other products that we have in the fixed income or income generation space, I think, are also interesting to portfolio construction. I think what's happening in ETFs at this point is that more and more tools are being created by many firms to facilitate leverage for investors that want to obtain a greater volatility in terms of their exposures. This is particularly true for Gen Z, things like 2x levered NVIDIA or Tesla ETFs. Those to me are really uninteresting products. They're misunderstood in terms of their return profiles. They are ultimately offering people basically the ability to juggle razor blades, not really the type of thing that I think is particularly interesting. But they are tools within portfolios. Within the broad tool set, I'd say that much of what Simplify has done up to this point is largely complete. Now it's a question of, can we take those same tools and offer refinements in other areas? So CTA, for example, has been complemented with another fund, HARD, that offers commodity focused exposure using many of the same techniques. That's had fantastic performance. It's just starting to catch attention, but if you check the size of it, you'll see it's a very, very small product. Other products like CDX, I mentioned, that has started to grow very nicely. The PCR product, brand new, et cetera. So we'll continue to introduce new products where we see a market opportunity. But I think one of the real challenges in ETFs at this space is just it has become so crowded and so focused on basically selling the flavor of the month that we're a little cautious about introducing a lot of new strategies right now.
Well, and again, for anybody who heard that and goes, okay, but some of that stuff sounds really complicated, I will say, because I admire folks who do it well on the back end, the Simplify website and the videos you guys are doing is a real help for somebody who's going, okay, let's see if I understand it and can get to where I want to get my head around it. Last question. We are now at the spot where you've got to be looking forward to be able to do what folks in your business do, make a forecast for 2026. I'm not asking to give away things, but, are you looking ahead thinking, we entered this year with people talking about whether we'd have a landing and what have you. We've been through heightened recession fears and less recession fears. We've talked about a bubble on a bubble in this interview. So as you look ahead right now, what's your are you optimistic, pessimistic? Here comes the rain.
Yeah. Well, I mean, look, I would emphasize that there are substantive cracks that have begun to emerge within the credit markets that weren't in place. They were at a smaller scale. We were experiencing elevated levels of bankruptcies, but the bankruptcies were largely smaller companies. Ironically, unfortunately, my work on passive suggests that one of the reasons why that ends up happening is because we funnel more and more assets and more investment to the very largest companies who really don't need it. We're ironically buying their stock as they're simultaneously buying their stock, again, contributing to effectively crowding and competition within strategies. Now that we're actually seeing those companies begin to stress their balance sheets, and companies like Meta and Oracle have significantly increased their debt in order to facilitate their participation in things like the AI bubble, I grow increasingly concerned that we are approaching the end of this. We have gone through the classic moment where firms like First Brands or Tricolor, which are large scale bankruptcies that have hit in the last month or so, those are starting to indicate that there wasn't really good behavior. There might even have been gambling in the casino. Shocked, I know. We should go round up the usual suspects. And they really are there. This time, of course, it falls into the category of what's called non-depository financial institution lending. The new game in town has been banks deciding that they were too large to engage in their traditional credit process in which they would lend to smaller businesses for equipment financing or new construction, et cetera. And instead, they've decided they're going to lend to high quality financial credits like private equity firms or private credit firms, or ETF firms offering leverage, that all falls into the umbrella of what's called non-depository financial institution lending. For the large money center banks, this is a fantastic business. It allows them to carry that same quantity of loans at a much lower capital charge on their balance sheets. That's looked on very favorably by regulators, but it introduces a series of additional risks that are not all that different from what we saw in the lead up to the global financial crisis, where the credit function itself has been very poor in its allocation framework. I think many of your listeners will recognize this. They've seen their children use buy now, pay later to finance their DoorDash deliveries. Again, NDFI, or levered ETFs that they have speculated on and seen spectacular moves in. These are all areas that have received just candidly too much money and too much leverage. And we're starting to see the cracks in that. If there's a pullback in that space, I think it's going to be very hard for us to avoid a recession. Whether that translates into something that looks like the global financial crisis or not is totally up to, the gods that be, in terms of whether we decide to print money to address it, whether we decide that the Fed should buy high yield bonds or buy equities if we begin to see those markets crack. That remains to be seen. But certainly at this point, I would suggest that economic weakness and a general slowing of the economy appears to be picking up steam. We're not getting the data from the government because of the government shutdown. The data that we are getting from the private sector, whether it's the NFIB, the National Federation of Independent Businesses, basically a proxy for smaller businesses, they're telling us that employment is incredibly weak. Their inventory levels are too high. Their ability to find qualified employees, i.e. tightness in the labor market, has improved dramatically. In other words, labor markets are much weaker. These are all things that suggest that the economy is slowing and rapidly approaching, if not already past stall speed. That could manifest itself in a recession. Again, that's facilitated by the fiscal consolidation that the Trump administration is engaged in through tariffs. Again, whether this plays out, whether we see a giant set of stimulus again, that's speculation at this point. My hunch is that there will be a recession, and a declared recession this time around, that ultimately manifests itself in lower market prices, and then we'll have to see what the response is to that.
Well, I don't know that I can say great stuff when we're talking about that we're going to see a recession, but I love the chance to get the opinion, and we will watch how it plays out. And it is great to get a chance to chat with you. Mike, thanks so much for taking the time to join me on Money Life.
My real pleasure, Chuck. Thank you for having me.
That's Michael Green. He's the chief strategist at Simplify Asset Management. Simplify.us to learn more about the firm and its funds. YesIGiveAFig.com to get to his Substack, his thoughts on financial markets and economics. We'll come back in just a moment. We'll put a bow on this show right after this message. Stay with us till the end, please.
Hey Money Lifers, it's Rob Floyd, the show's executive producer, and it's time for another contest where you can win a book that was discussed on the show. This week you're playing for Financial Success for the Rest of Us, Quality of Life Planning for Mainstream America by Dan Dorval, who appeared with Chuck on the October 9th show. And while the book is all about financial success, the contest is all about Major League Baseball teams that have never had success. Tell us 3 of the 5 Major League franchises that have never won a World Series championship, and 2 of them still have a chance at it this year, and you will be entered to win the book. Send your answer to chuck@moneylifeshow.com by noon Eastern Time on Saturday, October 18th to be entered for a drawing to win the book. And please put the word contest in your subject line. Good luck.
Thanks for sticking with us. We're going to keep this very short because we let our interviews run, especially the one with Michael Green. But a couple of great lines in there about juggling razor blades and a bubble on a bubble and much, much more. So hopefully you got a lot out of that interview, although he covered a lot of ground. And like the funds that he's talking about, Simplify's funds, they're simplified, but they're not simple, etc. So I do understand that one could be difficult, but I hope you found it valuable. Tomorrow on this show, my friend Herb Greenberg's going to be here. Yeah, and we will be talking about a piece he wrote for Herb Greenberg's Red Flags about how not normal is the new normal.
I need to understand normal.
Yeah, so we'll have some fun talking with him. Of course, Todd Rosenbluth will be here with the ETF of the week and more. So plan to be here. It'll be worth your while. Meanwhile, if you're looking for something to celebrate, there's a ton of things today. It's National Fossil Day. It's National Esthetician Day. It is Support Your Local Chamber of Commerce Day, which I'm in favor of because that means supporting your local retailers as well. It is National I Love Lucy Day.
Lucy, I'm home.
And that's because I Love Lucy premiered on this day in 1951. It is White Cane Safety Day for folks who might be walking with a white cane. And then, well, I don't even know if I should call this on the food front to start in. We do have a bunch of food things, but it's National Hagfish Day. Now, a hagfish is basically an eel. They're really disgusting, but in some cultures, it's considered a delicacy. And I am told by a friend of mine who has had it that the meat is mild, but the aftertaste is bitter.
Gag me with a spoon.
Yeah. I love a good food holiday, but I'm going to take the word of my friend who tried it. I'm not going to try it myself. Nope. Especially not today when it's National Mushroom Day. I love mushrooms. I can do a lot with those. It is National Cheese Curd Day.
Bless it all the cheesemakers.
Which, by the way, was founded by Culver's 10 years ago. And if you've never been to Culver's, go and get yourself a concrete. I would go for the cheese curds and the concrete. Totally worth it. But I don't have a Culver's near me. There are some near where my kids live. So maybe next time I go there. It's also National Chicken Cacciatore Day. It is National Shawarma Day. And I will point out it was National Shawarma Day a few years ago when I wondered aloud if there was a shawarma restaurant near me, and then I found one that has become a favorite for Gail and I when we're in that area. It's also National Lemon Bar Day. Love a good lemon bar, too. My guests today were Jacob Ayers Thompson. He's chief executive at 3AI, which is online at 3ai.co. Michael Scordo, wealth management advisor at Park Avenue Capital, which is a Northwestern Mutual company. It's the Northwestern Mutual 2025 Planning and Progress Study, the direct link in our show notes for you. And then Michael Green, chief strategist at Simplify Asset Management, simplify.us, his other website, yesigiveafig.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from me because, like last week, all of a sudden I had a quote of the day for Bloomberg that was mine from years ago. So I picked another one from me, which I don't do very often. But I like this one. It's simply, if you're not preparing for financial trouble, you're asking for it. Yeah. Well, don't go out seeking trouble except for when we take you to the danger zone. Instead, stay away from it. And remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Okay, save your batteries.